Good morning, everybody. It's Trent Klarenbach with Klarenbach Research. Today is October the 2nd, 2024, and I want to talk about oil again. Oil has been on my mind lately. We've produced a number of videos about oil, even did one on Baytex Energy yesterday, which I guess that's near and dear to my heart and a lot of the hearts of a lot of my friends back in my hometown and area I've lived in for the previous 16 years. But anyways, this here is the light crude oil futures chart. It's the daily chart. And you might remember, or maybe you missed the previous videos, how we talked about how we needed really to be above that $71, $72 level before we can become bullish light crude oil futures. Now, why is that? Why is that number important? Well, that represents the anchored volume weighted average price from the April 2020 low. And what the anchored volume weighted average price represents is the average price paid per contract since that point of time. So when we're above that anchored volume weighted average price, above this blue line, the average contract holder is in the green and they're feeling good about the positions. They're making gains and less likely to sell and more likely to add to their position. When we're below that anchored volume weighted average price, well, the average contract holder is not making money. They are losing money and they have losses, and they're more likely to exit their position rather than add to their losing position. So what happened is we had the sell-off back in September. We rallied back up to that $70, $71, $72 level, and we've been unable to close above that blue anchored volume weighted average price from the April 2020 low. And even with the rally on Tuesday after the Iran's bombing of Israel, we had that nasty spike in the morning. It was at 4% or something. It ended up closing 2.44% above. So 2.5% it closed up for the day. It's up again today, but again, once we get back to that, once the price gets back to the break-even level for the average contract position holder, they sell their position, they exit their position, they get back to even. They've been losing money, and now they're starting to exit their position. And we really need to get above there before we can get too optimistic about the price of oil. Now, we hear the headlines, World War III, we expect oil to spike, but really what matters more to most people is if they're making money or losing money on their position. So until they start making money on their oil position, I just don't think we're going to see a rally in the price of oil. Now that could happen tomorrow. We could get back above that $72 level, but in this case 71, 72. But I mean, really want to be aware of what the sentiment is of the market participants. Are they making money and feeling good? Or are they losing money and feeling bad? And I think that matters more than what the headlines and what we speculate might happen in the world economy or, certainly geopolitical affairs. That's the daily chart. Let's look at the weekly chart. Now, the weekly chart, normally I have the 50 and the 200-day moving or period moving averages on there. But this one I put the 30, 40, and 50. This is the period moving average, and the weekly chart's the 30, 40, and 50 week moving averages. Now I like using these moving averages in different times just to see, where the trend is going. And you can see here now there's been some consolidation. There's the moving average and crossing over one another. Well, we'll say back here and from March or November 2022, for the last 2 years, the price has been going up and down in a sideways consolidation. The moving averages are, representing that sideways consolidation. They're moving up, they're moving down, they're crossing one another. It really highlights the uncertainty of the market. Well, right now we're below those moving averages again, right? We're below that anchored volume weighted average prices, the weekly chart. And, we're really finding resistance from these previous support levels, right around that $70 level. So, the moving average is starting to curve down. They're starting to decline. We're below the declining moving averages. It's really hard to be optimistic about oil or certainly enter into a position with our strategy. But make the trade your own. We go back in time here and we can see, a similar situation from 2019 all the way to January 2020, moving averages crossing over one another as the price is fluctuating to a relatively narrow band of consolidation. And when the price made a new low below that the previous support levels, we saw a rapid sell-off in the price. Now, we all remember what happened in the winter of 2020, but nonetheless, these charts can give us clues to what might happen. On the contrary, or the reverse, you can see when we break above those period of consolidation, make a new high, enter into a stage 2 markup, the moving averages, they start rising, and that's where situations where we want to be long in the marketplace. So right now with oil, let's go back to the daily chart. We really need to get above that. Let's say 71, 72. Let's say $72 for a nice round number. We can become bullish regardless of the geopolitical events. That is our strategy. That is our opinion. Make the trade your own. My name is Trent Klarenbach. It's a great day in Saskatoon. Life's good.